Hello, my name is Bryan Zadeh. I am a VP of Mortgage Lending here at Guaranteed Rate and a branch manager. Welcome to our channel. Today, we're going to discuss some topics about down payment, asset, in other words, money that you have to purchase a home. There are some myths about getting a loan or purchasing a home that you need 20% down payment to start the process. That is not true. We can start the process in some cases with no money whatsoever. For example, on VA loans, but 3%, 3.5% down payment is very common. 100% is the purchase price of the home. So when you're buying a house, let's say $500,000, 3% of $500,000 is $15,000. And the myth was you need 20%, which is about $100,000. So this is a big difference. Some people cannot come up with that amount of money. There are always two sides about each story. When you are putting a bigger down payment, just notice that the amount of the loan shrinks. The purchase price was $500,000 and you're putting $100,000 down. Your loan amount is going to be how much? $400,000. So in the other scenario, when you're putting $15,000 down, your amount of loan is going to be $485,000. So the payment on $485,000 is going to be bigger than the payment on $400,000. So in this case, when you are putting less down payment, you have to be prepared to pay more for your loan per month. A lot of people find this actually appealing because they do want to keep the hard-earned cash and use bank's money to purchase their home. So there is another thing that you need to remember. While this is not the case every single time, when you put less than 20% down on your loans, most of the conventional loans require you to pay something called mortgage insurance. That's different from your home insurance that you always pay, right? You pay another insurance for the mortgage company. Why do you have to pay that? Just assume that you're purchasing a home for $500,000. You're putting only $15,000. So the bank or the lender carries $485,000 of debt. Imagine the market goes south and the price of your home plummets. It happens. Not necessarily historically this is the trend of the market, but it happens for short term. If the price of your home becomes $450,000, then your loan is bigger than your house value. In that case, if you walk away from that home, the lender is ended up with a loan that is bigger than the value of the home. That's why they insure that over 20%. They came up with this number of 20% to insure. There are some scenarios that you don't have to pay for mortgage insurance. There are some, for example, physician loans and other things, VAs, another example, VA Veterans Administration loan. You actually don't have to pay any down payment. The 100% of the loan, including some of the closing costs, is included. So this is the benefit that veterans are getting for serving our country. Therefore, plenty of different options. Each one of them is different. Two trains of thoughts. One train of thought is keep your cash, the lowest amount of down payment, find the sweet spot, get the biggest loan that you can, and purchase the home. The other train of thought is bigger down payment, less monthly payments. I'm not going to say which one is better because they're two completely different and works for two different types of people. But mainstream is when you're young, you want to keep your cash and use it in different ways. For example, buy other things, invest it. Not necessarily in stock market, invest it in real estate. Invest it in different ways, whatever you choose. The other train of thought is, I put as much as possible down payment to make my monthly payment lower. That is usually better for people who are worked many years and they want to actually live a comfortable and quiet life. And sometimes they are anticipating a shrink in their income when you're getting closer to your retirement age. In that case, you want to get as smallest loan possible. But in the beginning, we are new, you really want to keep your cash because cash, as everybody says, is king. I'm not a tax expert. You can talk to your CPA, but there are some tax benefits on getting a loan. Some of that could be actually deductible. But remember, the first step to purchasing a home is recognizing what you have in your bank account. A very important tip. The best bank account is the account with the least amount of transactions and the biggest amount of money in it. If you can provide to a lender 2 months worth of statements that has no transaction and it has $200,000 sitting in it, they would love you. But if the account has so many transactions going in and out, then they have to basically go through it and see what's going on in that account. And I bet you when you have 3-4 pages of transactions, there are some questions. What is this money going out? What is this money coming in? Questions need to be asked and then it needs to be answered. Some of the answers are not acceptable for some lenders. So it makes issues. Remember, when you want to start a loan process, make sure your money is in your bank account and is sitting there. The time that you're keeping your account and money in that account is called seasoning. 2 months is the normal seasoning that everybody thinks about. There are lots of possible options with less than that. 1 month only, 1 month bank statements. So don't keep your money in your mattress. Put it in a bank account and keep it there for 1 month or 2 just to make sure that we can source the money. It's coming from your account. I hope this was helpful. Please don't forget to subscribe, and more information about loan is coming every week. Thank you so much.